Whenever I say duration, Luke, does that make sense to you in terms of government bonds and interest rates?
Yeah, the way I use it in the banking context has to do with oftentimes you talk about the average duration of like a portfolio, and that's a nod towards how sensitive it is to changes in interest rates. So like something with a really long
Yeah,
duration just means if interest rates go up, then the price of on average is going to, go down.
exactly.
No use for dough. It's the root of all evil, of strife and upheaval. But I'm
A rough
certain that
approximation for overall risk. All bonds are not created equal. Some are riskier than others. Longer maturity bonds are going to be more volatile, more sensitive to changes in underlying interest rates. They have higher duration. So, what I wanted to talk about this week was a few different stories. And I think the common thread behind them all is kind of rising duration globally. And I think it's interesting to pick up on because you can have this happen without any additional bonds even being issued. This contributes to rising interest rates if you have too much of it. That then feeds into the deficits in the US. There's a lot of knock on effects, but the interesting piece is that it all depends on who owns the bonds out there today. And if that changes, you can have more duration in the system without any new bonds even being issued. So that's how I wanted to talk about it here. So the few things was the recent election in Japan that happened over the past weekend. They're facing upward pressure on their long-term yields as interest rates rise. That's going to, on net, make everything more expensive for the Japanese government. Second thing is that the CBO released its latest yearly 10-year look-ahead projections. So, surprise, surprise, they see deficits rising again, basically pretty consistently over the next 10 years. And then the last one is back to the Fed and what might be happening under the upcoming uh, administration under Kevin Warsh, namely shrinking the balance sheet or even just changing the composition of the balance sheet. So, all these things can contribute to this rising duration in the system. So, the question really is if all these things are happening, someone has to absorb all of this. And in order for that to happen, generally speaking, the price is going to have to fall to meet that demand. And I think you can see where I'm going with this now. Ultimately, this all feeds back into the deficit, into the growing deficit. Most importantly is if we're already facing issues like that at a time like today when the economy is really pretty good globally, what happens whenever the next recession hits?
So what's the thesis? It sounds like I guess the connection, it sounds like risk in general is entering the system, and we're not totally sure how it's going to be absorbed. And you use the term duration in I don't want to say a placeholder for risk, but somewhat interchangeably. That's new to me. I didn't really
Yeah, very,
think of it that
very,
way.
yeah, roughly speaking.
Okay. Okay. Cool thesis.
Ray Dalio's whole thesis of his investment methodology is to construct portfolios on the basis of net risk, not on the basis of how many bonds you're actually holding. So that's just one kind of
Okay,
side
cool.
reason why, it's, interesting to think about it this way.
All right, let's get it.
So let's start over in Japan. A lot of change going on over there right now. So the latest prime minister was elected late last year, not very long into her tenure. She pulled this kind of what was seen as a politically risky move to see if she could shore up additional support from her party. But in the end, it ended up working out really well for her. So she ended up getting a supermajority that she's just got full reign to basically do whatever she wants. So pursue
Wow.
her agenda.
Jace, can you imagine? Can you imagine like 2/3 or something filled with Republicans in the Senate and House? Oh, that would be wild. It's unheard of. It's like, when was the last time that happened? Yeah. Okay. Oh, good for her. Rolled the dice.
Yeah, she rolled the dice and it all worked out really well. The market reaction was basically how you would expect. So stocks went up quite a bit. The 10-year JGB yield was up almost 10 basis points, I think about 2.25%. And this is in the context of the 10-year yield in Japan being basically zero only about 3 years ago now. So it's not like it's just increased a little bit. It's like just a totally different regime that they're dealing with right now. And one of Takaichi's core tenets of her plan for the country is increased fiscal spending, in part to help combat the cost of living crisis that's still sweeping uh, across the globe. So all in all, this is what we've been seeing for a while now. She's had these plans for fiscal expansion. It's the largest stimulus since COVID that she's proposed. And we're seeing that through markets so far. She's been quoted recently as kind of pretty tolerant overall of a weakening yen. That can be really helpful or really difficult depending on the way that you look at it. From the perspective of Japanese businesses that are heavy exporters, it makes you more competitive globally. Your exports are going to be cheaper relative to the rest of the world. But internally, the weaker yen, it's not going to have as much buying power. If you're in a country like Japan, it's a relatively small island. They're heavily dependent on imports, for many industries across their economy. It makes all of those things just mechanically more expensive, kind of all at once. So she's trying to juggle these two things that kind of combat this cost of living crisis. One of the main ways of doing that is increased fiscal spending by the government, but that's going to increase government bond yields, making that fiscal spending even more expensive. And it's been weakening the yen at the same time. So this is kind of the angle that I started to touch on earlier, that this kind of current concoction of events here, what the government's doing, what the yen is doing, it's on net leading to higher interest rates in Japan, and kind of all else equal, you're getting higher long end rate risk.
I didn't realize that they also had a quote unquote affordability crisis. Is there any one thing in particular that's the problem? Is it like housing? I think the main thing here is it's just like housing is becoming a growing proportion of your revenues. Yeah, in the U.S. Is that the same case?
No, it's actually really strange. So that's one of the big perpetrators of this ongoing deflation over the previous few decades. The cost of housing in Japan basically hasn't budged since the early 90s or even late 1980s, whenever their housing bubble crashed.
So what's driving it then?
It's kind of two main things to me. Number one, they're seeing inflation for the first time in over 30 years. So that's one thing. People aren't used to seeing prices rise. People aren't used to getting salary increases. Someone could have spent their whole career basically never getting a salary increase. That's just a very different psychology than what we're used to.
Right.
America.
I did hear something about the kind of the Japanese one. Just recently, it's sort of bonus merit increase time over here in the U.S. Like, I don't know if you've talked to your manager or something, but you're kind of expected to get an increase at the amount of inflation, at least, right?
Yeah, exactly.
Maybe they did the same thing in Japan. It's just been zero for so long. That combined with maybe the culture, maybe you're not supposed to. It's impolite to ask for a raise if you're not doing a whole lot more or something. Yeah, interesting. So it's inflation. It's like they're getting crushed by 2-3% inflation.
And the weakening yen. So the yen has weakened like nearly 50% since COVID. That means all imports are now 50% more expensive. That's just massive.
Yeah. And the 2 to 3% inflation, that's average across an entire economy worth of goods. So maybe there's some stuff overseas that people want. Like, I remember when I was in China, there was a big problem with baby formula. The Chinese really didn't have problems like buying stuff, but baby formula was, they wouldn't get the local stuff. They would really demand the foreign stuff, like from Australia. That's where like the good baby formula was. And the prices were super high. I mean, it's already like really high here, but I remember that being a problem. So I can imagine something similar to like that in Japan, where 2% is not, it's a good number. It's a small number, but there might be products in there which are very important, but have to be imported. And then all of a sudden the price of those have gone up 3x or some ridiculous amount. So maybe that's, don't have any specifics here,
Right.
but I could see that.
So Japan, Takaichi, big win over there. She's got a full, very strong political mandate to pursue her goals of higher fiscal spending, trying to combat the cost of living crisis over there. So what does that mean for the US, though? So that's the part that I wanted to touch on next. Rising rates in Japan, there's actually a direct connection to rates in the US. It used to be China not too long ago, but Japan is actually the largest holder of US Treasuries. For the longest time, government bond yields in Japan, even like including the longer duration stuff, the 10-year was pinned down to zero explicitly by the Bank of Japan for many years. They were structurally not earning any yield on their own government bonds at home, so they would buy treasuries. Now that the 10-year has gone up from 0 to 2.25%, the long end's even closer to like 4% now. That difference to US Treasuries isn't so large anymore. It's reasonable to assume that Japanese investors, at least to some extent, would repatriate some of those investment dollars. If they sell treasuries, that's going to push the rates up in the US as well. And again, that all feeds back into the deficit. So even if we do nothing different in the US, we don't issue more debt, we don't change policy, we don't do anything like that, it's going to increase our interest burden even further.
So walk me through the transaction would be, or the calculus would be that Japanese investors are holding a bunch of treasuries, and they're going to decide that they're holding treasuries. That's obviously USD. So what's the transaction? They're just going to sell it, get USD cash, and then exchange it for the yen?
Yeah, I mean, pretty much. It's, you're sitting on cash. If you're buying government bonds, you want something that's going to store your value, earn a little bit of yield, ideally. So they could either sell the US bonds outright or just let them mature and then not reinvest into dollars. That means someone else in the US or globally for that matter is going to have to pick up that additional issuance that was being bought by Japanese investors. Now it could possibly be the case that now in America, someone else has to pick up that. And so this is the initial angle I was saying here. Someone has to buy that extra duration now that's entering the market. Going into last year, there was a lot of skepticism around Trump's new policies before they were put into place. The One Big Beautiful Bill Act, the tariff regime, and there was very negative sentiment at first, and then months later, then we even did a whole video about this as well, about how they revised their projections to make the overall fiscal outlook look much better. The question is now, a year in to these policies taking hold, how has that outlook shifted?
So this is just from one report to another. So last time it would have been taken at February 2025. So this is before Liberation Day. They didn't know when the tariffs and stuff would hit. Gee, I don't know. It's a good question. I got better. I mean, I think in general, okay, so I guess I've got some views here. Maybe it's because I'm just listening to Scott Bessent a little bit more, who's with the Trump administration, and he has to paint a very rosy, positive picture. So he's saying, oh, look, we're getting,
it's the best
growth
it's ever
is going
been.
up. Yeah. We're starting, yeah, exactly. Growth is super high. I think we had some point where we were faster than China or something, depending on how you looked at it. Just the story is that we set the groundwork in 2025, and now we're going to reap the benefits in 26. Everything's awesome. We're going to get a whole bunch more money from tariffs, right? So the government deficit's going to go down. We haven't really checked into the tariff revenue for a little while. That would be worth looking into. Everything's great. Everything's great. So admittedly, I'm a little biased here just based on my source of information and stuff, but let's say it looks better. I hope it looks better than it did a year ago. That's going to be what I have to say. But what does it actually say?
Let's see. Changes in budget since Jan 25. Deficit for this year is now 0.1 trillion or 8% higher in the current projections as compared to the ones done last year. Over the 10-year period, 1.4 trillion higher, 6% greater over that 10-year window.
Oh, whatever. This stuff isn't important, Joe. We know these numbers are all made up. Throw it out.
Right,
Throw it out,
right.
Joe. Let's. You got to look at the details. Devil's in the details. They're just making stuff up.
That's what we're going to do. They say 3 major policy developments. The 2025 Reconciliation Act, higher tariffs, reduced deficits by 3 trillion, while that tax act increased by 1.7 trillion. So let's get to the good stuff. Let's get to the table here. Scott Bessent has been very proud of so far is that I think the projection for the yearly deficit was something like 6.9%. And something that he's been touting whenever people criticize that is that over 25, the actual realized one, and we can see this here, is 5.8% it came out to. So while these numbers are still really high, that's no small feat to at least push it in the right direction by just about 1%, maybe just over 1%. Back to Bessent's outlook, though, fundamentally is 333 plan. He said by the end of 2028, he expects it to be down to 3%. But whenever we look at the CBO's projections here, that doesn't quite seem to be the case. So if we look 2025, again, realized at 5.8%, 26, they think it's going to be flat, 5.8% as well. Decrease a little further the year after to 5.7, but for all intents and purposes, pretty flat. Certainly not on the fast track to 3%, where Bessent would want it. But then you look out to 2036, 10 years from now, and it increases by just about a full percent, just about where it was before Trump entered office. So what's happening there?
Yeah, just looking at it, net interest went up by 1.3. Other ones went down. The interest is a killer. Medicare, we've also talked about a lot on this. That's a headwind. Social Security, yeah. I mean, payroll taxes, individual income taxes went up as a percent basis for some reason.
It's this net interest payment that's just killing us.
Yeah. All right. That drives me crazy. The other thing is the fact that the mandatory part drives me nuts. The mandatory doesn't actually mean it's mandatory. It's just a label that they stuck on there.
Right.
Congress can do whatever it wants. They write the law. They can do whatever they want. There's no mandatory thing.
They can call it mandatory. They could just get rid of it.
Yeah, they could just get rid of it if they wanted to.
That's what they do. They write the law.
They change kind of they change like how old you got to be to before you become eligible for it. They can do whatever they want. So I sort of bristle at that, but let's see. Yeah.
This is certainly not a news story for us. We know that the fiscal outlook is looking really bad, and so it started to look like it might improve going into throughout 2025. They revised their projections, even at one point saying that expected tariff revenue is expected to fully offset the decreased revenue from the tax cuts in the tax bill. But that doesn't quite seem to be the case anymore, at least, on a net total basis. We see this deficit just slowly growing over the next 10 years. And this is at a time whenever unemployment, and this is happening at a time where we're not in any major crises. We're not in a war. We're not in a recession. Unemployment's really low. The economy seems to be looking pretty solid. But deficits are just growing more and more still. It's these good times whenever we're supposed to kind of pay down the deficit a little bit. But we're seeing the exact opposite, and it's just really unclear where this is all going to end up.
Yeah, I'm going to make a call out to to Americans, there's this huge opportunity here, which is to just disrupt the healthcare industry. Please, you'll save the country for the country. You could do it. It's possible. It's out there. There's a business opportunity.
We're basically at World War II levels, and there's basically just no hope for it to go down, at least according to these projections. So pretty decidedly negative outlook this year from the CBO.
All right. You're breaking my heart here, but all right. You're breaking my heart. Here, you're going to end on a positive note?
I'll try, but probably not. In addition to that, some of their economic projections, and I guess this is sort of the mechanism behind why we're seeing the interest rates increase. But in this table here, we can see that, for the Fed funds rates, they actually see this thing falling, a decent bit further from here over the next 10-year period, kind of falling a little bit over 26 and then staying flat. But they see the longer term yields go in the opposite direction. And so that's really what is driving the long-term growth in that overall interest payment. So we see the 10-year fall a little bit, they think, into 26, but then increasing over the few years after that, and then 10 years out, increasing a little bit more. So we've touched on this before, how useful of an exercise even is it to try to assign a point estimate to the 10-year Treasury yield 10 years from now? You can really debate that, but I think the point is that they see front-end rates coming down, but long-end rates rising still. Again, usually you see those things move in the same direction. If the Fed is cutting, they see lower economic output, lower economic growth. You'll see longer-term yields falling instead. We're seeing them rise. It's just negative on negative here. So they see economic growth slow down while they're seeing 10-year, longer term Treasury yields increase. So all these things are just, lower economic growth. You can't pay down the deficit as much. Higher long-term yields. It's increasing the deficit at a faster rate. It's really a tough situation.
Yeah, that's a pretty dark outlook. It's not good. 1.8% growth. That's not good. Besson, again, the 333. I think he wanted, 3% growth? That's one of them?
Yeah.
Originally, I've heard some people, like in the All In podcast, I think they misquoted, or they spoke to him directly, and I thought they got the numbers wrong. They were saying, was it 3% inflation? That's, I think, the number they would say. 3% growth, and then like a 3% deficit. That's not right. I think the 3% inflation thing is not that. It was 3 million barrels of oil a day. Maybe, I don't know, maybe Besson changed it or something. But I think 3% growth is in there.
I don't think so. But in fact, though, he hasn't really been talking about the 333 plan very much. I don't know about you, but I actually haven't even heard him mention it.
That's true.
Basically, kind of since the beginning of his tenure. Yeah, maybe he's trying to back away from that a little bit.
Yeah, sorry. Yeah, 3% budget deficit, 3% economic growth, and 3 million barrels of oil a day. Yeah. All In podcasts kept saying it was 3% inflation, and that's not what it was.
Yeah, that's definitely not right.
That doesn't make sense. That's not right. Yeah, 1.8%, that's pretty pathetic. They're not even going to think, they don't think like AI is going to come in and start talking. Like, didn't Trump get up there and say we're going to hit 15% growth?
He did say that
or something.
Recently.
He did? Okay, so I'm not just making this up. Good. I didn't just dream that.
Yeah. No, it sounds crazy. It sounds made up, but yeah, I'm pretty sure he said 15%. That one's
let's do it. So I'm talking. That's
pretty
about.
good.
Let's keep going.
Yeah. We need the lowest interest rates.
AI. If you were to ask, something like Musk or something, they think you're going to have a whole bunch of robots in like 5 years. The amount of output then it's going to be insane. It's going to be, you can't comprehend stuff like that. That's what they think, and they're talking like 3-5 years.
That's the outlook. Yeah, and that's kind of I guess one answer to the question. What do things look like from here? Does it get even worse? Do we hit some recession and QE starts again? Or do we have this really rosy outlook where economic productivity just explodes, inflation goes down, interest rates come down with it, and just economic activity just goes through the roof? We've just got millions of robots doing all of our jobs every day. We pay down our debt down to zero. Everyone gets UBI. Life is good, right?
UHI. That's what they're going for. Universal high income.
What is that? Okay. Rebranding already before it even exists. I certainly hope that's what happens. That would be a great future. But I just can't help but be skeptical. That last episode, whenever we talked about it, I just think Musk is a little bit in the Trump 15% growth area whenever he says some of the things that he says like that. Way overestimating what probably will happen. But I don't know. We'll see.
Yeah, it could happen. I'm in that camp. Sure.
It's wild. All right, well, back to interest rates here, the really interesting stuff, if you will. But yeah, last thing I want to talk about, these long end rates, they're a problem in so many different ways. We could be seeing pressure from overseas investors, domestic spending just not keeping up at all with outlays, debt to GDP just at near all-time highs and just projected to keep going further. I've got one more piece of really good news about this. In the days just after Warsh was nominated to be put up as Fed chair, a lot of hemming and hawing about what that's going to mean. But by and large, he's a pretty mainstream candidate, and the market hasn't reacted really all that much. But he has made some comments in the recent past that could have really big effects on the overall state of monetary policy and fiscal policy, for that matter. Namely, this guy, Rich Clarida, so he was on the board previously up until about a few years ago. He's worked with Warsh for a number of years. He came out and made comments more or less stating that Warsh is very critical of the size of the Fed's balance sheet. And so we're likely going to see some sort of reduction to the balance sheet under his under a Warsh-led Fed. Now, it's really unclear how they might do that, but one of the interesting ways that was cited in doing that is this thing known as a Fed Treasury Accord. And so this is kind of an interesting thing that, to kind of gloss over it here, this was last done in 1951. In the post-war era, the U.S. government, so fiscal spending, worked with the Federal Reserve. They put monetary policy together with fiscal policy to basically help fund the war. These were unprecedented times. But then in 1951, they separated the two again. Over the coming years, we might see something similar today, a similar agreement between the Fed and the Treasury, but in the opposite direction.
Sorry, what is this? Yeah. Okay, go ahead.
So the Treasury Fed Accord, so it says March 1951, they reached an agreement to separate government debt management from monetary policy. So that's effectively saying this was the political independence. So the Fed was no longer working in tandem with the Treasury Department. That was seen as necessary during World War II, but then they separated that. And for the past 75 years or so, that's been the case. So that's one of kind of the foregone conclusions today when people think about monetary policy and the Fed, they think about political independence. There's certainly a lot of hemming and hawing about that today with everything that Trump has been doing over the past year. But the idea here is that for a new accord, it would kind of do the opposite. So rather than separate the Treasury and the Fed's functions, this would explicitly coordinate the two. Warsh is really critical of the Fed's balance sheet. He wants to see a smaller balance sheet. The Fed can't just start selling securities into the market. Well, they could, but it would make this ongoing interest rate problem even worse. What they could do is then to coordinate with the Treasury to shift their longer term holdings.
And and what? Like, what are they going to do? Well, what are they going to do? I'm waiting with bated breath here. Like, what's the?
The Fed would coordinate with the Treasury in the Treasury issuance schedule. Given the composition of the balance sheet, if the Fed is going to say that, okay, our longer term holdings, I'm Kevin Warsh, I want less longer term holdings, I want less holdings overall. Those are two things that he's expressed. He could call up Besant, tell him that, and then Besant's going to say, okay, we're going to decrease the size of the long end Treasury auctions because the Fed's going to be letting more of this duration back into the market. We don't want to exacerbate that problem by issuing more debt at that point.
Oh, okay.
It's explicit coordination between fiscal policy and monetary policy. Fiscal policy is, part of the Trump administration. That's, exactly not political independence anymore.
Okay. I don't know. It seems like a pretty narrow band of the overlap. I mean, all you're saying is, in my understanding anyway, is like you go to Besant and say, hey, look, we're going to sell a bunch of long-term treasury bills into the market. Maybe don't go out and auction 30-year stuff. Do some shorter term stuff so that the market could more easily absorb it. That's a pretty narrow band of like what monetary and the fiscal stuff coming together. I would think.
It is a narrow band, but keep in mind, the size of this market is $30 trillion. So even small tweaks to any of the issuance schedule could have a big impact. And it's not just the Treasury, quote unquote, helping Warsh get the Fed balance sheet down. The other way could work as well. Besant could have a direct say in monetary policy effectively. So a member of the federal government could be dictating terms of U.S. monetary policy. So that's kind of like the underlying is one thing is that in a way that's kind of the end of political independence in the US of the Fed, at least for now. But that's the point. We've seen this in the past. It's not a foregone conclusion to be politically independent for a central bank. That's how we've done it for the past 75 years. There's a lot of good arguments for that and a lot of doom and gloom for if that wasn't the case anymore. But even beyond, Trump trying to pressure the Fed chair, this is a whole different route at which this could happen that, again, is a little more, I guess, marginal, you could say. But if this were to happen, it wouldn't be nearly as fantastical as, Trump tweeting saying you need to lower interest rates now. That's a really quick and easy story. This way, it's like, okay, Besant talked to the Fed and they coordinated on their auction sizes and the schedule in which they occur. To the everyday person, that's not really a very newsworthy item, but it could have major impacts, again, on that long end of the curve. And it all feeds through back to the deficit.
That's kind of interesting. We'll definitely keep a lookout for that. Accord stuff, Fed independence, a little more closer coordination, quote unquote, if you want to put it nicely, between the Fed and the Treasury.
Yeah, very interesting times. All right, well, that's pretty much it. I was going to talk about non-farm payrolls. This was a big surprise to the upside. It looks a lot stronger than people thought. All else equal, that means the Fed is not going to be able to cut as much. So as we're getting this new Fed chair who says he wants to cut so much, if we see the data start to turn against that, and he's getting pressure from the Treasury, that really puts him in a tight spot. So big implications, again, for the long end interest rates in the US. So a lot of moving parts right here. They are all connected, and it's not always obvious to see what those channels are, but that was my intention here today, to try to draw some of those linkages.
Yeah, no, I mean, like, what goes into determining longer term interest rates is always fascinating. It's just so incredibly, fantastically complex. I know that there are interest rate traders and stuff like that. I wonder how they think about it, but it's not going to be that simplistic.
They think about it in these ways.
Yeah, which is interesting. Not something I think about directly. I'm more of just a taker of like whatever the rate is, that's what it is. I don't try to think of what's influencing it. It's way too complicated. So it's interesting. It's nice to have an insight into someone who does think about how these rates move and why they go the way they go and what's pushing it. So thanks for that, for Joe.
Of course. Well, with that, thanks for tuning in. This has been another episode of the Root of All Evil podcast. I'm Joe.
I'm Luke.
And we'll see you next time.
All right. Bye.